This is what you need to know when you short stocks. First thing first, you need a margin account to short stocks. You can't do it from your regular cash account. To open a margin account, you have to read and agree to additional disclosures from your broker, and then you're good to go. Be careful with a margin account. You have a leverage of 2, and it means that you have increased risks of losses. In this video, I'm not talking about the traders falling under the PDT, the day traders with a leverage of 4. So when you have a margin account, you will be able to short stocks. So basically, you will borrow stocks from your broker. You will sell them on the market in a hope of their price going down so that you can buy them back, make a profit, and give them back to your broker. That's how it works. In certain cases, you are even able to sign a security lending agreement so that if you have shares long on your account, your broker can take these shares and lend them to somebody who wants to short this stock. And in exchange, you will get an additional tiny revenue. Right, so now you have your margin account, you have money in it. If you have $10,000, you have a leverage of 2, so you can get the equivalent of $20,000. Let's pretend that you want to short Apple. Apple is on the easy to borrow list of all the brokers. It's mega cap, no problem whatsoever to short stocks. But small caps and other stocks might be on the hard to borrow list, meaning that depending on your broker, they might not be able to provide you with these shares. They have to locate these shares. They have to speak with other brokers. They have to check out with locate providers. And usually, if you want to short a small cap that is hot on a given day, you have to ask your broker early in the morning to locate these shares so that you can get these shares. But then you also have a list of stocks that you can't short. The New York Stock Exchange, for instance, can decide that these stocks is too volatile, too risky. They won't allow you to short this stock. Your broker has the obligation to provide you with this list. Okay, now I want to go to the blackboard to explain to you the margin calls and maintenance call that you may have, because when you short stocks, you have additional requirements. If you haven't watched the video about margin call, here is the link. It's a little bit complicated, but it's really important that you understand how it works. Let's pretend you have $25,000 in your margin account. With Regulation T, you can borrow the same amount, $25,000, and therefore you have $50,000 that you can use to short a stock, for instance. Let's pretend that you want to short a stock that is currently priced at $50. So here is what the calculation is. Short market value plus equity equal credit balance. Short market value is $50,000. What's your equity? Your equity is $25,000. What is the credit? $75,000. So that's the start of everything. Now you short the stock at 10 a.m. in the morning, and at the end of the day, the stock now worth $60 a share. $60 a share. So it goes against you. So let's do the same calculation. What is the market value? It's $60,000 this time. The credit balance stays the same. So the only thing that can change now is the equity. $75,000 minus $60,000 equal $15,000. What is a maintenance requirement? When you short a stock, the maintenance requirement is 30% of the market value. So what is 30% of $60,000? It's $18,000. This is the margin requirement. What is your equity? Your equity is $15,000. So you have $50,000, but you need $18,000. It means that you are missing $3,000. So now the broker must ask you a maintenance call. He will ask you to put $3,000 of cash or $6,000 worth of stocks. Because of the regulation T, you only take 50% of that. Okay, so we see that if the stock goes against you, in that case, it's 20% against you, you owe money to your broker. So imagine if the stock goes like crazy against you 50%, 100%, 200%, 300%. You will owe a lot of money. You can actually owe way more than what you initially had. When you short stock and you use leverage, it's a recipe for disaster if you don't know how to compute all these numbers, because you can really lose a lot of money. And on top of that, with small caps, you can have alts. Let's see an example. This morning with this stock, it's a small cap, they had a news, and it opened the day up already 185%. So let's pretend that for any reason you want to short this stock, you check it out with your broker, and they were able to locate for you some shares. You see this green candle and you might think, okay, it's time for me to short. I think it's a false breakout and the stock will go down because I believe that the news is not that big of a deal. Let's have a look to what happened next. So first of all, there is a halt. A halt is triggered because of high volatility, for instance. You have several websites that provide you with all the halt. For instance, this one is right there, BMAR, and the reason is high volatility. If you want to understand exactly how it works, you can go directly on the NASDAQ, New York Stock Exchange, and another website. It's quite long, actually. It's not that simple. So we have several reasons why a stock can be halted. It might be for pending news. It might be for several things. And you have to know that when a stock is halted, all the trading is stopped. For instance, here, the halt happened right there. And 10 minutes after, when it resumed the trading, it started there. So you can see that from where you short and when it opened, it's already up 12%. Then it bounced back down and it went up again. Okay, then it halt again. So usually it halts for 10 minutes. So for about 10 minutes, you are super stressed out. You don't know because remember, you are short here. You want the price to go down. So now you are right there. Let's see. It goes back down a little bit. You have hope. Now it's going back up. And it's going back up. And I will stop there just for the sake of this demonstration. So the price went from 8.59 up to 17. It's about 100%. What does it mean? It means that you have lost everything. At this stage, you have lost everything. So be careful when you short stocks. I would recommend to short with a small amount at the beginning and start with large caps so that you don't have to deal with halts, because as you can see, it's really dangerous. I hope this video was helpful to you. Thank you for watching and see you in the next one.